October 1929, the month Wall Street died. But this isn't a story about death. It's about birth. The birth of the greatest lie ever sold to the American people, that prosperity is permanent, that markets only climb, that everyone can get rich if they just believe hard enough. What happened in those final weeks of October wasn't an accident. It was mathematics catching up with mythology. And when the numbers finally spoke, they screamed. The 1929 crash stands in American memory like a tombstone, a single moment when everything went wrong. But that's the first lie we need to bury. This wasn't a moment. It was a culmination. A decade of reckless optimism, unchecked greed, and willful blindness converging into an inevitable catastrophe. To understand how America fell, you need to understand how high it climbed on a ladder made of borrowed money and broken promises. The 1920s didn't roar. They howled with the manic energy of a nation drunk on its own success. World War I had ended. Europe lay in ruins, and America stood alone as the industrial colossus of the world. Factories churned out automobiles by the millions. Henry Ford's assembly lines made cars affordable for the working class. Radio broadcasts connected farms to cities. Electric lights replaced candles. Skyscrapers pierced the clouds. Every day seemed to bring another technological miracle. Another reason to believe that humanity had finally cracked the code of perpetual prosperity. But beneath the jazz music and flapper dresses, beneath the champagne toasts and ticker tape parades, the foundation was rotting. American farmers were already in crisis by the mid-1920s. Agricultural prices had collapsed after the war ended, leaving millions of rural families drowning in debt they could never repay. The prosperity everyone celebrated was grotesquely unequal. The top 1% controlled nearly 40% of the nation's wealth. Millions of workers earned barely enough to survive, while industrialists built mansions with dozens of rooms they'd never occupy. The banking system was a house of cards. With minimal federal oversight, nearly 30,000 banks operated across America, many of them small, undercapitalized institutions that lent money with reckless abandon. There was no federal deposit insurance, no safety net. If a bank failed, depositors simply lost everything. And banks were failing even during the boom years, a warning sign everyone chose to ignore. But none of this mattered to the American public, because they had discovered a new religion, the stock market. Between 1921 and 1929, the Dow Jones Industrial Average exploded from 63 points to 381, a 600% increase in less than a decade. This wasn't just Wall Street getting rich. For the first time in history, ordinary Americans, school teachers, shopkeepers, factory workers, became stock investors. Brokerage houses opened storefront offices in small towns. Newspapers ran daily stock quotes. Radio programs featured market commentary. The stock market had become the national pastime, replacing baseball as the great American obsession. Everyone had a story about someone who turned a few $100s into thousands. Your neighbor, your barber, the guy who delivered your milk. They were all getting rich, or so they claimed. The fear wasn't losing money. The fear was being left behind, missing out on the greatest wealth creation opportunity in human history. This wasn't investing. It was a mass delusion, and like all delusions, it required constant reinforcement to maintain. Here's where the story turns from foolish to fatal. The 1920s market boom was built on a financial innovation that would prove to be Wall Street's most dangerous weapon: margin trading. The concept was seductively simple. Instead of paying cash for stocks, investors could borrow most of the purchase price from their broker. The typical margin requirement was just 10%. Put down $1,000 and you could control $10,000 worth of stock. The mathematics seemed magical. If your stock rose by 20%, you didn't just make $2,000 on your $10,000 position, you had tripled your initial investment of $1,000. Leverage turned modest gains into spectacular profits. Every small investor could become a titan of finance, riding borrowed money toward riches. But leverage is a double-edged sword that cuts deeper on the way down. If your $10,000 position dropped by just 15%, you'd lost more than your entire initial investment. And here's the killer. Brokers could issue margin calls at any time, demanding that investors either deposit more cash or sell their positions immediately. In a rising market, margin calls were rare, but in a falling market, they became a death spiral. Imagine 10,000 investors, all leveraged 10 to 1, all holding the same stocks. The market dips by 5%, nothing catastrophic. But that 5% drop triggers margin calls across the board. Investors scramble to find cash, but most don't have it. They're forced to sell. The selling pushes prices down another 5%, triggering more margin calls, forcing more selling. The cycle feeds on itself, a financial avalanche where every falling stone dislodges a dozen more. By 1929, billions of dollars in margin loans hung over the market like a sword. Everyone knew it was dangerous. Few understood just how dangerous. The Federal Reserve, America's central bank, had begun raising interest rates in 1928, trying to cool the speculative fever. But the fever was too far advanced. The patient was terminal, but nobody wanted to cancel the party to perform the autopsy. What makes the 1929 crash so darkly comedic is that the smartest men in America, the economists, the bankers, the politicians, spent the final months before the collapse assuring everyone that nothing could go wrong. These weren't confidence men running a scam. They genuinely believed their own propaganda, which makes their failure even more instructive. Charles E. Mitchell, president of National City Bank, today's Citibank, was one of the most powerful financiers in America. In March 1929, as cracks began appearing in the market, Mitchell announced that his bank would lend money freely to prevent any downturn. "We feel that we have an obligation which is paramount to any Federal Reserve warning," he declared. Translation: "I know better than the central bank, and I'll fight any attempt to restrain this magnificent boom." President Herbert Hoover, elected in 1928, promised a chicken in every pot and a car in every garage. He believed that American prosperity had reached a new, permanent plateau thanks to scientific management and technological innovation. The old boom and bust cycles were finished. Modern America had evolved beyond such primitive economic problems. But the most infamous prediction came from Irving Fisher, Yale's renowned economics professor, and one of the most respected economic thinkers of the age. On October the 17th, 1929, less than 2 weeks before Black Thursday, Fisher announced to the press, "Stock prices have reached what looks like a permanently high plateau. I do not feel there will be soon, if ever, a 50 or 60 point break from present levels." The Dow stood at 326 points when he said this. Within 3 years, it would fall to 41. Fisher wasn't a fool. He was brilliant, genuinely brilliant, a pioneer in monetary economics whose work still influences the field today. But brilliance is no defense against cognitive bias. Fisher was heavily invested in the market. His personal fortune depended on stocks continuing to rise. He had built elaborate mathematical models proving that current valuations were justified. Like a skilled magician, he had hypnotized himself with his own tricks. This is the crucial lesson. Expertise and intelligence don't protect you from bubbles. If anything, they make you more vulnerable, because they give you sophisticated tools to rationalize what you desperately want to believe. The smartest people in the room are often the last ones to see disaster coming, because they have invested too much, intellectually, emotionally, financially, in the status quo. September 1929. The market reached its peak on September the 3rd, when the Dow hit 381.17. For a few weeks, prices drifted sideways, like a car that's run out of gas but hasn't quite stopped rolling. The volume was lighter. The enthusiasm was muted. Professional investors, the men who actually understood how markets worked, began quietly selling their positions. They didn't announce it. They didn't warn anyone. They just slipped out the exit while the band was still playing. Roger Babson, a financial analyst and entrepreneur, gave a speech on September the 5th at the annual National Business Conference. Sooner or later, a crash is coming, he warned, and it may be terrific. The market dropped sharply that day. The Babson break, newspapers called it. But within days, it recovered. The optimists mocked Babson as a perpetual pessimist, a doomsayer trying to get attention. Surely this was just another temporary correction. But the decline had started, slow and grinding. Throughout September and early October, stocks drifted lower. Nothing dramatic, just a steady erosion. Investment trusts, the 1920s version of mutual funds, began showing cracks. These trusts had bought stocks on margin, just like individual investors, and they were starting to face margin calls of their own. A few smaller banks failed in agricultural states, barely making the news. The pieces were moving into place. Then came mid-October. The selling accelerated. On October 18th, the market dropped sharply. October 19th brought more losses. By October 23rd, panic was spreading through trading floors. Something was breaking, but nobody knew exactly what or how badly. The machinery of American finance was seizing up, gears grinding against gears, and the operators at the controls were discovering that none of their levers worked anymore. The New York Stock Exchange opened at 10 o'clock on Thursday morning, October 24th. Within the first hour, it was clear that something unprecedented was unfolding. Sell orders flooded in from across the country, from brokerages in Chicago, from banks in Boston, from individual investors who'd received margin calls and had no choice but to liquidate. The volume was staggering. 12.9 million shares would trade that day, shattering all previous records. But the real horror wasn't the volume, it was the panic. Prices weren't just falling, they were collapsing. Stocks that had been stable investments for years suddenly had no buyers at any price. The ticker tape machines, which transmitted stock prices across the country, couldn't keep up. They fell minutes behind, then hours behind. Investors across America were trading blind, not knowing if they were selling at a loss or a catastrophic loss. On the floor of the exchange, chaos reigned. Traders screamed themselves hoarse. Messengers ran between posts carrying hastily scribbled orders. The heat and crush of bodies was suffocating. Outside, a crowd gathered on Wall Street, thousands of people staring up at the exchange building, sensing catastrophe, but not yet understanding its scope. Rumors spread that the exchange would close, that banks were failing, that fortunes were being wiped out by the second. At noon, the panic reached its peak. Then, something unexpected happened. Richard Whitney, vice president of the exchange and floor broker for J.P. Morgan, walked calmly onto the trading floor. He approached the post where U.S. steel was traded and placed an order to buy 10,000 shares at £200.5, well above the current panicked selling price. Then he walked to other posts, placing similar orders for other blue-chip stocks. The message was clear. The House of Morgan, America's most powerful financial institution, was stepping in to support the market. Whitney was acting on behalf of a consortium of bankers who had pooled millions of dollars to stop the panic. It worked, at least temporarily. Prices stabilized. The late afternoon even saw a modest recovery. When the market closed, many stocks had actually finished the day slightly higher. Newspapers the next morning were cautiously optimistic. Worst crisis in markets history is believed past. One headline read, "The Wizards of Wall Street had saved the day." But they had only bought time, and not much of it. Friday, October the 25th was relatively calm, though volume remained heavy. Saturday, trading, the market operated 6 days a week, then saw more modest declines. Over the weekend, America's financial and political leaders worked furiously to restore confidence. President Hoover released a statement. The fundamental business of the country is on a sound and prosperous basis. Treasury Secretary Andrew Mellon echoed the sentiment. Bankers gave interviews promising that the worst was over. But in living rooms and kitchen tables across America, a different conversation was happening. Families were tallying their losses, trying to understand what had happened to their savings. Margin calls, GATA, were arriving by telegram and telephone. Investors faced an impossible choice. Somehow find cash to meet the call, or accept that their positions would be liquidated at devastating losses. Most didn't have the cash. Many didn't even understand what was happening to them. They'd been told that stocks only go up, that America's prosperity was unstoppable. Now their brokers were demanding money they didn't have to cover losses they'd never imagined possible. Monday, October the 28th, brought renewed selling. The artificial support from Thursday's banking consortium had evaporated. The banks couldn't keep buying indefinitely without bankrupting themselves. More margin calls went out. More forced selling hit the market. The Dow dropped 13% in a single day, one of the worst single-day declines in history. But this was just the prelude. Tuesday, October the 29th, 1929. The day the world changed. The day that would haunt American memory for generations. The day that proved, beyond any doubt, that the prosperity of the 1920s had been a magnificent illusion. The opening bell brought a tidal wave of sell orders. Within minutes, it was clear that Monday's losses would be dwarfed by what was coming. 16 million shares would trade that day, a record that would stand for decades. But the raw numbers don't capture the terror, the sense that the entire financial system was disintegrating in real time. Prices didn't fall, they cratered. Stocks that had been worth hundreds of dollars dropped to a fraction of that in hours. Blue-chip companies, The supposedly safe investments lost a third of their value before lunch. Smaller stocks simply vanished. Hours would pass without a single trade because there were no buyers at any price. Margin calls cascaded through the system like falling dominoes. Every forced sale pushed prices lower, triggering more margin calls, forcing more sales. The ticker tape machines, already hopelessly behind on Black Thursday, now faced an impossible task. By the afternoon, they were running hours late. Investors across the country were blind, frantically trying to reach their brokers by telephone, jamming the lines, begging for information. Most couldn't get through. Those who did often learned they'd been wiped out hours ago and were only now hearing about it. Outside the exchange, the crowd had swelled to thousands. Police were called to maintain order. Rumors of suicides spread, though most were exaggerated or false. But the despair was real. Men who had been millionaires at breakfast were destitute by dinner. Families who had borrowed to invest lost not just their savings, but their homes, their farms, their businesses. The margin loans that had magnified gains on the way up now amplified destruction on the way down. When the closing bell finally rang at 3 o'clock, the carnage was total. The Dow had lost another 12% on top of Monday's 13% decline. In 2 days, the market had lost a quarter of its value. In a month, it had lost nearly half. But this wasn't the end. It was just the beginning. Here's what every account of the 1929 crash gets wrong. They treat it as if the crash itself was the disaster. It wasn't. The crash was the symptom, not the disease. What came after the crash, the grinding, years-long destruction of wealth and confidence, that was the real catastrophe. November 1929 brought a brief false rally. Bargain hunters stepped in, convinced that quality stocks were now undervalued. The market recovered about 20% from its lows. Newspapers declared the worst was over. Investment advisors urged clients to buy the dip. For a few months, it seemed like maybe the optimists were right. Maybe this had just been a healthy correction, a necessary purging of excess speculation. They were catastrophically wrong. The rally was a dead cat bounce, the final gasp of a dying patient. In April 1930, the decline resumed. It would continue, with brief interruptions, for nearly 3 years. The Dow wouldn't hit bottom until July 1932, when it touched 41.22, an 89% decline from the September 1929 peak. 89%. Imagine taking every dollar you had invested in 1929 and being left with 11 cents. But even that doesn't capture the full horror, because it treats the stock market crash as if it happened in isolation. It didn't. The crash was the first domino in a chain reaction that would topple the entire American economy and much of the world economy with it. Banks had been the enablers of the stock market bubble, lending freely to speculators and investing their depositors' money in stocks. When the market crashed, banks found themselves holding loans that would never be repaid and stock portfolios that were worth a fraction of what they'd paid. But banks operate on confidence. Depositors must believe their money is safe, or the entire system collapses. In late 1930, the first major waves of bank failures began. The Bank of United States, a private bank with a deceptively official-sounding name, collapsed in December 1930, taking $400 million in deposits with it. Thousands of depositors lost their life savings. The failure triggered panic at other banks. Depositors raced to withdraw their money before their bank failed too. But these bank runs became self-fulfilling prophecies. Banks couldn't survive when everyone demanded cash simultaneously. They had lent most of it out, as banks do. Withdrawal demand forced banks to liquidate assets at fire sale prices, which made them insolvent, which justified the panic that had started the run. The Federal Reserve, which had been created in 1913 specifically to prevent banking panics, failed utterly. Instead of flooding the system with emergency cash to stop the runs, the Fed tightened money supply. Their reasoning was that maintaining the gold standard, the policy of backing every dollar with gold reserves, required conservative monetary policy. They sacrificed the banking system to preserve an ideological commitment to gold. Between 1930 and 1933, more than 9,000 banks failed. 9,000. That's not a crisis. That's an extinction event. Millions of Americans lost their savings, their security, their trust in the financial system. Businesses lost access to credit, making it impossible to operate or expand. The banking system, which should have been the foundation of economic recovery, became the instrument of destruction. The stock market crash and banking crisis were financial disasters, but they metastasized into an economic catastrophe that destroyed lives in tangible, brutal ways. By 1933, unemployment hit 25%. 1 in 4 Americans couldn't find work. In some cities, the rate exceeded 30%. These weren't lazy people choosing not to work. These were skilled workers, family breadwinners, people who desperately wanted jobs that simply didn't exist. Industrial production collapsed by nearly half between 1929 and 1932. Factories closed or slashed production to a fraction of capacity. The automobile industry, the symbol of the 1920s prosperity, saw production drop by 75%. U.S. Steel, once the epitome of American industrial might, operated at just 19% capacity. Trains ran empty, stores closed. The machinery of American capitalism ground to a halt. But statistics don't capture the human suffering. Families lost their homes when they couldn't pay mortgages or rent. Shantytowns, Hoovervilles, named bitterly after the president, sprang up on the edges of cities, collections of scrap wood and cardboard where the dispossessed tried to survive. Soup kitchens fed lines of hungry people that stretched for blocks. Farmers, already struggling before the crash, now faced complete ruin as agricultural prices fell below the cost of production. Some farmers burned their corn for heat because it was worth less than coal. The psychological trauma was as devastating as the material loss. Men who had been providers, who had taken pride in supporting their families, now stood in bread lines or rode the rails looking for work that didn't exist. The suicide rate spiked. Marriages crumbled under financial pressure. Birth rates plummeted as couples couldn't afford children. The American dream, the promise that hard work and thrift would lead to prosperity, revealed itself as a cruel joke. The Great Depression wasn't just an American crisis. It was a worldwide catastrophe, and American policy choices made it far worse. In June 1930, President Hoover signed the Smoot-Hawley Tariff Act, one of the most economically destructive pieces of legislation in American history. The tariff raised import duties to record levels, supposedly to protect American farmers and manufacturers from foreign competition. It had the exact opposite effect. Other countries retaliated with their own tariffs. Global trade collapsed by 2/3 between 1929 and 1934. American exports plummeted, destroying what was left of American agriculture and manufacturing. The tariffs turned a severe recession into a global depression. Meanwhile, the international financial system was locked into the gold standard, a monetary straitjacket that prevented countries from responding flexibly to the crisis. The gold standard required countries to maintain fixed exchange rates and limit money supply based on gold reserves. When the crisis hit, this meant that countries couldn't lower interest rates or increase spending without risking a run on their gold reserves. Countries that abandoned the gold standard early, like Britain in 1931, began recovering sooner. Countries that clung to it, like the United States until 1933 and France until 1936, suffered longer and deeper depressions. The lesson was clear. Ideological commitment to a monetary system mattered less than pragmatic response to human suffering. But ideology often wins over pragmatism, especially when the people making decisions are insulated from the consequences. The Depression didn't just reshape economies, it shattered political systems and created the conditions for some of the 20th century's greatest disasters. In Germany, already suffering from the punitive Versailles Treaty and hyperinflation of the 1920s, the Depression was the final blow. Unemployment hit 30%. The weak Weimar Republic couldn't respond effectively. Into this chaos stepped Adolf Hitler and the Nazi Party, offering simple answers to complex problems, scapegoats for legitimate suffering. By 1933, Hitler was Chancellor. By 1939, the world was at war. In the United States, Herbert Hoover's presidency collapsed under the weight of the crisis he couldn't or wouldn't address adequately. Hoover wasn't heartless. He believed deeply in volunteerism and limited government intervention. But his approach was catastrophically insufficient for a crisis of this magnitude. In 1932, Franklin Roosevelt won the presidency in a landslide, carrying 42 of 48 states. His mandate was clear: do something, anything, to end the suffering. Roosevelt's New Deal was an alphabet soup of government programs: the CCC, WPA, TVA, AAA, and dozens more. Some worked, some failed, but collectively they represented a fundamental reimagining of government's role in the economy. The government would become an employer of last resort, a regulator of financial markets, a guarantor of bank deposits, a provider of social insurance. The classical liberalism of the 1920s, minimal government, self-regulating markets, individual responsibility, was dead, killed by its own failure to prevent catastrophe. The Securities and Exchange Commission, SEC, was created to regulate stock markets and prevent the kind of speculation that had fueled the bubble. The Federal Deposit Insurance Corporation, FDIC, insured bank deposits, ending the terror of bank runs. The Social Security system created a basic safety net for the elderly and disabled. Labor unions gained legal protection. These weren't just policy changes. They were a complete restructuring of the relationship between citizen, economy, and state. Here's what makes the 1929 crash eternally relevant. The psychology that created it is hardwired into human nature. We are pattern-seeking creatures who extrapolate trends into infinity. When things are going well, we convince ourselves they'll go well forever. When things are going badly, we can't imagine they'll ever improve. This emotional volatility, this inability to think rationally about uncertain futures, makes us perfect victims for financial bubbles. Every bubble has the same structure. It starts with something real, a genuine innovation or change. In the 1920s, it was electrification, automobiles, and radio. In the 1990s, it was the internet. In the 2000s, it was housing and credit innovation. The initial investment makes sense. Early investors profit. Others notice and join in. Prices rise, which seems to validate the investment thesis, which attracts more investors, which pushes prices higher still. Eventually, prices become disconnected from any rational valuation. But by this point, nobody cares about rational valuation. The only thing that matters is momentum. Prices are rising, so you need to get in before they rise further. Late arrivals pay prices that make no sense, but they're not planning to hold forever. They just need to sell to someone else at a higher price. The game becomes musical chairs, with everyone dancing faster as the music speeds up. Then the music stops. It always stops. Sometimes it's a technical factor. Rising interest rates, a regulatory change, a major investor selling. Sometimes it's just exhaustion. The pool of new buyers finally runs dry. But once prices stop rising, the entire logic collapses. If you can't sell at a profit, you need to sell to avoid a loss. But everyone realizes this simultaneously. The stampede for the exit begins. Prices don't decline, they disintegrate. The bubble pops, and everyone acts shocked, as if it was impossible to see coming. The four most dangerous words in investing are, "This time is different." Every bubble believes it's unique, that the old rules don't apply, that we've reached a new paradigm. In the 1920s, it was the idea that modern management and technology had eliminated the business cycle. In the 1990s, it was the new economy, where internet companies didn't need profits to be valuable. In the 2000s, it was the belief that housing prices never fall nationally, so mortgage-backed securities were perfectly safe. The details change, but the delusion is always the same. We've evolved beyond risk, beyond cycles, beyond the basic laws of economics. This time, we figured it out. This time, the party really can last forever. And every single time, without exception, it ends the same way. In tears, recrimination, and a desperate search for someone to blame besides ourselves. The 1929 crash should have vaccinated us against this delusion. It didn't. The dot-com bubble of the late 1990s saw identical patterns. Companies with no revenue valued at billions. Day traders quitting their jobs to speculate full-time. Experts proclaiming that traditional valuation metrics were obsolete. When it burst in 2000 to 2001, trillions of dollars evaporated. Then, barely 7 years later, we did it again with the 2008 financial crisis, built on the same foundation of excessive leverage, blind faith, and regulatory failure. Why do we keep falling for the same trick? Because bubbles feel amazing while they're inflating. You feel smart, you feel rich, you feel like you've figured out the secret that everyone else is too cautious or too stupid to see. Admitting that you're riding a bubble means admitting you're a fool, that you're going to lose money, that you need to step away from the party while everyone else is still dancing. That's psychologically almost impossible for most people. The 1929 crash revealed a truth that makes people deeply uncomfortable. The financial system is not designed to protect you. It's designed to extract value from you. The brokers who encouraged margin trading in the 1920s made money from the transaction fees and the interest on margin loans. They profited whether you won or lost. The banks that failed in the Depression didn't fail randomly. They failed because they'd taken enormous risks with other people's money, knowing that if the bets paid off, they'd get rich, and if the bets failed, depositors would absorb the losses. This same dynamic plays out today. When you hear advice to stay invested for the long term or buy the dip, ask yourself, who benefits from you following that advice? Often, it's the people selling you financial products, the advisors who earn fees on assets under management, the platforms that profit from trading volume, the institutions that need retail investors to provide liquidity. This doesn't mean you shouldn't invest. It means you need to understand that you're playing a game where the house has advantages you can never overcome. The house has better information, faster execution, more sophisticated tools, and, most importantly, less emotional attachment to specific positions. When the crash comes, and it always comes eventually, the house will cut losses and move on. Retail investors will hold and hope, watching their savings evaporate. The real lesson of 1929 is that you cannot rely on experts, institutions, or government to protect you from financial catastrophe. Irving Fisher, the brilliant Yale economist, lost his entire fortune in the crash and spent the rest of his life in debt. President Hoover and the Federal Reserve had all the power and information in the world, and they still made decisions that turned a crash into a depression. The banks that were too big to fail in the 1920s failed anyway, taking millions of depositors with them. So what do you do with this knowledge? How do you protect yourself in a system that's fundamentally unstable, driven by psychology rather than rational valuation, and prone to catastrophic failures every generation or two? First, abandon the fantasy of getting rich quickly. The people who survived the Great Depression and even prospered through it weren't the speculators or the leverage traders. They were the boring investors who held diversified assets, who understood that wealth is built slowly over decades, who never bet more than they could afford to lose. They were the farmers who owned their land outright, the families who had minimal debt, the business owners who had cash reserves to weather the storm. Second, understand leverage as the enemy. Margin trading destroyed more wealth in 1929 than the actual market decline. If you own stocks outright and the market falls 50%, you've lost half your money. Painful, but survivable. If you're leveraged 2-to-1 and the market falls 50%, you've lost everything. Leverage amplifies gains but multiplies losses, and the losses always come when you're least prepared for them. Third, question the consensus. When everyone agrees that markets will keep rising, when experts are unanimous in their optimism, when strangers at parties are giving you investment tips, that's when you should be most afraid. The worst time to enter any market is when it feels safest, because that safety is an illusion created by the bubble itself. The best time to invest is when you're terrified, when everyone else has given up, when conventional wisdom says you're a fool for buying. But that requires psychological fortitude that few people possess. Fourth, maintain real assets and emergency reserves. The people who survived the Depression with their dignity intact had food, shelter, and savings that weren't dependent on the stock market or the banking system. In modern terms, this means having months of living expenses in cash, owning your home outright, or having minimal housing debt. Possessing skills that have value regardless of economic conditions. It means not being dependent on systems that can fail. Finally, and most importantly, educate yourself relentlessly. Financial literacy is the only real defense against financial catastrophe. You need to understand how markets work, how bubbles form, how leverage kills, how institutions fail. You need to know enough to ask the right questions, to spot the warning signs, to distinguish between genuine opportunity and speculative mania. Ignorance in finance isn't bliss, it's a death sentence. Look at our current financial system, and you'll see the ghosts of 1929 everywhere. Central banks have spent the last 15 years injecting trillions of dollars into the financial system, keeping interest rates artificially low, inflating asset prices far beyond what fundamentals would justify. Stocks trade at valuations that would make 1929 investors blush. Real estate in major cities is priced as if prices can only rise. Cryptocurrency markets make the 1920s stock bubble look rational by comparison. And just like in 1929, everyone has an explanation for why this time is different. It's technology, it's globalization, it's central bank policy, it's the shortage of investable assets. It's a new paradigm. Pick your justification. They all lead to the same place. The moment you believe that risk has been eliminated, that's the moment you're in maximum danger. The 2008 financial crisis should have been our wake-up call, our 1929 moment that forced fundamental reform. We got some new regulations, some stress tests for banks, and then within a few years, we were back to the same game. Leverage is higher than ever. Speculation is rampant. The warnings from risk managers and contrarian analysts are dismissed as pessimism. The music is playing and everyone's dancing. Here's the final, most unsettling truth about the 1929 crash. It never really ended. The financial crisis became the Great Depression, which created the political instability that led to World War II, which reshaped the entire global order. The decisions made in those years, the turn toward Keynesian economics, the expansion of government power, the creation of the social safety net, the abandonment of the gold standard, still govern our world today. We're living in the long shadow of October 1929. Every financial regulation, every central bank policy, every political argument about government's role in the economy traces its lineage back to that moment when the system failed so spectacularly that no one could pretend it was working. The New Deal, the welfare state, the regulatory apparatus. These weren't ideological choices as much as they were desperate responses to failure. But we've forgotten the lessons as we've become comfortable with the solutions. The regulations have been watered down. The safeguards have been dismantled. The speculation has returned, wearing new clothes but dancing to the same old tune. We've convinced ourselves that we're smarter than our grandparents, that we've fixed the problems they faced, that we've evolved beyond their primitive mistakes. We haven't. We're just waiting for our own crash, our own moment of reckoning, our own discovery that the prosperity we've taken for granted was built on foundations of lies.